It begins with a historic announcement. The United States government declares that it will no longer fund Social Security. The news spreads instantly, sparking widespread concern among retirees, near retirees, workers, and financial institutions. Social Security, long regarded as a cornerstone of economic stability and retirement security, has supported tens of millions of Americans for decades. Its sudden cessation sends shockwaves through personal finances, household budgets, and national economic expectations. Investors, economists, policymakers, and everyday citizens are left grappling with unprecedented uncertainty. The first immediate impact is felt in household finances. Millions of Americans who rely on Social Security for a significant portion of their income suddenly face the prospect of drastically reduced cash flow. Seniors, disabled individuals, and families relying on survivors' benefits confront immediate financial hardship. Consumer spending, particularly on essentials such as food, healthcare, housing, and utilities, drops sharply. Retailers, grocery chains, healthcare providers, and housing markets feel the immediate effects, reflected in declining sales and revenue. Stock markets respond as consumer-driven sectors anticipate lower demand, resulting in early signs of market volatility. Financial institutions respond quickly. Banks, credit unions, and investment firms scramble to adjust their projections for mortgage repayment risk, loan defaults, and credit exposure. Lending conditions tighten as risk models are recalibrated to account for widespread financial distress among Social Security beneficiaries. Stock valuations for banks, credit card issuers, and consumer finance companies reflect heightened risk and anticipated changes in loan performance. Corporate strategy undergoes a rapid transformation. Companies with significant exposure to consumer spending begin revising revenue forecasts and adjusting production schedules. Firms in healthcare, pharmaceuticals, retail, and housing confront immediate pressure as their customer base experiences reduced disposable income. Stock prices for these sectors adjust downward in response to anticipated declines in sales and profitability. The labor market is affected in multifaceted ways. Younger workers facing uncertain retirement prospects are incentivized to increase savings, work longer, or delay retirement. Older employees may continue working beyond traditional retirement age, impacting job availability for younger generations and creating shifts in wage dynamics. Stock markets for industries dependent on employment patterns, such as services and consumer goods, experience adjustments reflecting potential changes in demand and labor costs. Pension and retirement funds face heightened pressure. Private retirement plans, 401ks, and pension funds experience increased demand as individuals seek alternative sources of income to replace lost Social Security benefits. Investment managers face complex decisions regarding asset allocation, risk management, and liquidity. Stock valuations for asset management firms reflect anticipated growth in advisory services while simultaneously facing risk exposure to market volatility. Consumer confidence collapses in the immediate aftermath. Surveys show a dramatic decline in optimism about personal finances, retirement security, and household stability. Reduced consumer confidence translates into lower spending, deferred purchases, and a slowdown in discretionary consumption. Stock markets for consumer discretionary sectors, including automotive, travel, and luxury goods, reflect these downward pressures. Financial markets experience systemic volatility. Equities, bonds, and derivatives, sensitive to consumer behavior and interest rates, react to the sudden loss of Social Security funding. Risk appetite among investors decreases, with flight-to-safety behavior observed in government bonds, gold, and cash equivalents. Stock indices experience swings as investors reevaluate exposure to consumer-driven sectors, financial institutions, and long-term investment products. Government operations face secondary consequences. Reduced Social Security payments alter fiscal flows, potentially freeing funds for other programs, yet increasing political contention. Federal agencies tasked with oversight, compliance, and public communications must respond to widespread public anxiety. Stock markets for companies providing government-related services, including technology, consulting, and infrastructure, experience uncertainty as operational priorities shift. healthcare and pharmaceutical sectors are significantly impacted. Older Americans facing financial hardship may delay elective procedures, reduce prescription purchases, or forgo preventive care. Stock valuations for healthcare providers, hospitals, and pharmaceutical companies reflect potential reductions in demand alongside increased reliance on government safety nets or charitable services. Housing markets respond unevenly. Seniors and disabled individuals dependent on Social Security may struggle to meet mortgage payments or property taxes, creating localized pressure on housing demand and rental markets. Stock valuations for real estate investment trusts, ERADs, mortgage lenders, and housing service providers reflect anticipated adjustments in revenue and occupancy rates. Corporate credit exposure rises. Companies providing products and services to demographics reliant on Social Security face higher default risk. Banks and credit institutions recalibrate lending standards and interest rates to reflect increased risk, impacting both stock valuations and long-term credit market stability. Consumer debt dynamics shift. Credit card balances, personal loans, and other unsecured debts become riskier as borrowers lose a key income source. Delinquencies rise, influencing stock prices for banks, collection agencies, and credit reporting firms. Investors adjust expectations for revenue and profitability in financial services sectors. Employment patterns adapt. Older workers delay retirement, resulting in potential labor market congestion, altered wage dynamics, and shifts in employment opportunities for younger workers. Stock markets for employment-sensitive sectors respond to projected changes in workforce availability, compensation structures, and productivity. Financial advisors and wealth management sectors experience surging demand. Individuals and households seek guidance on alternative income streams, investments, and retirement planning. Stock valuations for advisory firms, financial planning services, and asset management companies reflect anticipated revenue growth, although market volatility remains a concern. Political and social ramifications intensify. Public protests, legal challenges, and political pressure mount as affected citizens demand solutions or alternative support. Legislative responses are uncertain, with partisan conflict potentially delaying corrective action. Stock markets react to uncertainty, with volatility increasing as political risk becomes a central factor in economic projections. Consumer spending patterns undergo long-term adjustment. Households prioritize essentials over discretionary goods, while savings behavior increases in anticipation of future uncertainty. Retail, travel, leisure, and entertainment sectors experience sustained revenue pressure reflected in stock valuations. Insurance markets adjust to rising risk exposure. Life insurance, long-term care, and annuity products face increased demand as individuals seek to protect against loss of Social Security income. Stock markets for insurance companies reflect growth potential alongside heightened actuarial and market risk. Corporate strategy increasingly focuses on risk mitigation and demographic adaptation. Companies expand services tailored to older demographics, diversify revenue streams, and explore alternative markets. Stock prices respond to firms demonstrating adaptive resilience, operational flexibility, and innovation in product offerings. Global financial markets react to potential macroeconomic implications. Reduced U.S. consumer spending affects multinational corporations with significant American revenue exposure. Foreign investors reassess risk, adjusting capital allocation and investment strategies. Stock markets for exporters, multinational companies, and globally exposed firms experience fluctuations. Investment patterns shift toward essential services, healthcare, and income-generating assets. Investors favor sectors resilient to reductions in government income programs, leading to sector-specific gains amid broader market volatility. Stock valuations reflect these strategic reallocations. Corporate mergers, acquisitions, and strategic partnerships accelerate in targeted sectors. Companies seek to consolidate market share, diversify offerings, or acquire services for older demographics. Stock prices respond to anticipated synergy, revenue potential, and operational resilience. Labor markets adapt to increased private sector dependency. Demand for financial advisors, healthcare providers, Senior services and housing solutions grows. Employment patterns shift towards sectors mitigating the absence of Social Security, influencing stock valuations for companies providing these services. Consumer behavior evolves over the medium term. Households increasingly rely on private retirement savings, family support, and alternative income streams. Spending remains cautious while investment in long-term financial security increases. Stock markets for financial services, insurance, and consumer staples reflect sustained demand. Government policy faces ongoing scrutiny. Potential for partial restoration of Social Security, alternative programs, or tax incentives becomes a central political issue. Stock valuations respond to market expectations for policy intervention or sustained disruption. Credit and mortgage markets remain sensitive to demographic risk. Older households facing reduced income influence lending standards, interest rates, and housing market stability. Stock markets for banks, mortgage providers, and REITs adjust accordingly. Technology and service sectors adapt to demographic needs. Healthcare technology, home automation, remote monitoring, and financial planning software see increased adoption. Stock valuations for technology providers in these sectors reflect anticipated growth driven by necessity and demographic adaptation. Consumer confidence stabilizes gradually if alternative income sources emerge. Investment behavior, consumption patterns, and corporate earnings projections adjust over time as households adapt to reduced government support. Stock markets begin to reflect long-term recalibration rather than immediate panic. Corporate governance focuses on demographic intelligence. Companies incorporating insights on retirement security, consumer behavior, and alternative income solutions outperform peers, reflected in stock performance. Financial markets experience long-term adaptation. Investors allocate capital toward resilient sectors, demographic-tailored products, and essential services. Stock indices reflect both risk-adjusted growth and market stabilization, as households, firms, and policymakers adjust to the new economic reality. Global trade and investment patterns shift. Reduced U.S. consumer spending affects import volumes while demand for domestic services rises. Stock markets for multinational exporters, domestic service providers, and essential goods producers reflect changing trade dynamics. Employment and labor market structure evolve. Older workers participate longer in the labor force, while younger workers adjust career strategies. Stock valuations for firms dependent on labor-intensive industries reflect changing workforce dynamics and productivity considerations. Corporate debt and equity markets adjust to long-term uncertainty. Companies diversify funding strategies, increase operational resilience, and hedge exposure to consumer income volatility. Stock prices respond to strategic foresight and risk management capability. Consumer and investor education accelerates. Financial literacy, retirement planning, and wealth management become increasingly critical as households navigate the absence of Social Security. Stock valuations for educational, financial advisory, and wealth management services reflect market expansion. Infrastructure, housing, and healthcare sectors face growing demand. Companies provide services tailored to an aging population, now lacking government support. Stock markets respond to sustained revenue potential in these essential sectors. Policy uncertainty continues to dominate headlines, influencing investor sentiment, corporate strategy, and consumer confidence. Stock markets reflect both short-term volatility and long-term opportunity as firms and households adjust. The scenario illustrates how a complete cessation of Social Security funding would reverberate across the U.S. economy. From household finances to corporate strategy, from financial markets to labor dynamics, the impacts are widespread and multifaceted. Stock markets reflect immediate disruption, sectoral recalibration, and long-term adaptation as businesses, investors, and households navigate a fundamentally altered economic landscape. Ultimately, the absence of Social Security would redefine retirement planning, consumer behavior, corporate strategy, and financial market dynamics. While the short-term impacts are severe, long-term adaptation by households, firms, and investors could stabilize the economy and create opportunities for innovative solutions to address the gap in government-provided income.